I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market was mixed to sharply lower last week, and that barely speaks to the dramatic action seen in a lot of other markets. Early in the week, markets chopped around, awaiting the FOMC meeting, which was on Tuesday and Wednesday, and for the policy statement and the presser on Wednesday. Tuesday did see the release of record inflation numbers. The PPI was up 0.8%. A year over year, that was 6.6%, a record. The core was up 5.3%, that year over year, and that's versus the 2% target that we see from the Fed. If this doesn't bring you to a place where the Fed has to take action, well, I don't know what would. And of course, we did see some things change. Wednesday, the market was quiet until 2 p.m. Eastern when the Fed statement came out. And clearly, the dot plot had changed. The governors overall saw 2 rate hikes coming between 22 and 23. Wow, is that a long way out? 7 of the 18 governors did see a rate hike coming in 22. They still did say things like inflation was temporary, but they did say that the labor market was to get very strong, and they did upgrade GDP, as Powell said in the press conference. What really changed was the tone of the markets, was the announcement that said that they were no longer going to be talking about tapering, but now they're actually talking about tapering. So everything was going to be kind of month to month or meeting to meeting when they would be looking at the potential for beginning to taper. Short-term interest rates spiked on that news. The long-term rates just popped a bit, and then they came back down. The yield curve did flatten on that news. Gold and silver did move down, and commodities overall got under pressure. Thursday was a much worse day for commodities, but on Wednesday the S&P 500 was down as much as 45 points and then rebounded to only small losses. What's happened here is the Fed has engineered a recovery on the backs of savers and retired people and working people, especially lower income people who are going to take the hit on this inflation. It's a travesty, if you ask me. It's a tax on the poor. Transitory inflation, they're never going to get this back. And between the inflation from last year and the huge inflation this year and what they're going to get in next year, which will probably be 3 to 4%, you're talking about a tax of 10 to 12% on the people that plainly can't afford it. That's the problem with these Fed policies, is that they are completely misdirected and totally disruptive to the markets. We need to get back to the free organic markets and stop hurting the people that they're trying to help. It's totally absurd. Well, Thursday, we could see that things had really changed. The yield curve got even flatter. Metals got hammered. Gold and silver collapsed. Gold fell $87 on Thursday, silver $1.86, and these were nightmare breakdowns, and it caused us to do revisions, at least on the short term, for the gold and silver market. The longer term may still be okay. I'm not going to talk much about that in this show, but you could check Future Speak on Wednesday. The grain markets got absolutely hammered. Oil fell. Financials were weak, those financial stocks, on a potential margin squeeze as the short end of the interest rates go up, essentially their source of funds, and then the longer end of interest rates don't go up. As a matter of fact, they tried and then fell off, and that does give you a potential problem for the financials. I'm going to show you the chart on the financials at the end of the show as a comparison to the stock market, and I think you're going to find it very interesting. But all of a sudden, there is a whiff in just a moment of a sentiment change in the markets. A potential reduction of the creation of funny money. And that brought huge changes in sentiment in the markets. Stocks on Thursday, well, they were mixed as the long end of the curve bonds rallied, and that did fuel a tech rally. We saw tech firming even stronger on Friday as the lower interest rates in the long end, or the failure for a big rally of interest rates on the long end, are helping those tech stocks, and that's helping the NASDAQ. On Thursday, the S&P 500 was unchanged. The NASDAQ was up 180 points, but the Russell was down 27 points, and the Dow Jones was down 210. At the same time, the Dow Jones Transportation Average fell 2%, 318 points. Talk about a mixed market, and this is just a ton of thrashing going on, and that does happen at market peaks. Talk about getting killed. The corn market, which suffering from the sentiment change, the grains on a whole, corn was down 40-cent limit, and the bean market was down $1.23. That absolutely was a collapse for the grains, and I'm going to show you the analysis on the grains coming up in a few minutes also. It was just a wild day on Thursday, and this sets a major tone change in the markets. Friday, well, stocks were already weak, and Fed Bullard came out and he confirmed the FOMC has policy change in focus. And he is another one, and he reiterated the first interest rate change is likely to happen in 1922. Well, that is a long way off, but the markets get way ahead of these things, and we saw the S&P 500 fall 40 points pre-opening, and this is a quadruple witching day here on Friday, which can be quite chaotic. So we're having a day here on Friday where, again, the markets are weak, but the NASDAQ isn't quite as weak, though it is showing some signs of beginning to give some ground. And we do think that the NASDAQ will be getting pummeled before this corrective period is over with, as they realize that there probably is nowhere to be safe. So the stock market pullback that we're getting now is timely based on our work, and we were calling for a June peak for the last several months. It's interesting, the focus on the Fed aligns with our timing, and maybe that says that there is something to these natural money flows that we look at. It's important to see the massive breaks in everything speculative, with Bitcoin having actually led the way. But NFTs and SPACs and now the green markets and the metals, well, they've all just started a great unwind. And this doesn't happen in one day. In fact, it doesn't happen in 1 week, and it doesn't happen in 1 month. So there's likely to be a lot of time out there when the markets are having a lot of trouble. Stocks, well, that stock market, when you get up close to 200% of GDP, you have almost nothing to compare it with. And it is their turn. After all, they're about the last ones that are holding up. And we have said that the peak was coming somewhere around this time in June, early July, and we think the peak is here. And a rocky second half is coming for the stock market. For the week here at midday, we have the S&P 500 down about 1%, the Russell down 2.5%, the Dow down over 3%, and this is the worst week for the Dow in about 9 months. And the NASDAQ is fractionally higher at this point. So the market, we'll call it a mixed week, but man, was there a lot of things that did crater. we think that NASDAQ benefit of the longer-term rates, which of course are inflation sensitive, that the strength that we see this week is not going to last, and we're going to see the NASDAQ moving down sharply with the rest of the market. The bond market also a wild week. 30 years gained 3/4 of a point. Yes, the 30 years went up 3/4 of a point on the week that the FOMC said that they're getting ready to have a policy change that would raise interest rates. The 30-year yields fell 9 basis points. That's 30-year. At the same time, the 10-year yields went up 4 basis points. So that was a 13 basis point move in just the 10s to 30 yield curve. That is pretty big, and that's why the financials are acting so poorly, as this bank margin squeeze is potentially right out in front of them. Gold, which had that horrendous day on Thursday, fell 100 points on the week. That's 5.6%, $100. That's the biggest since the COVID panic. Silver down $2, more than $2 now, and that's about a 7% decline in the silver markets, as all of these things that depend on the Fed liquidity are really getting hammered. And that does, again, I'm going to repeat myself, the stock market is not going to be unscathed. For the dollar, it was a huge week, a 2% gain, and something very significantly has changed in the dollar market, as both the safety bid comes in and the effect of the higher short-term rates brings money into the U.S. dollar. And the Fed pending policy shift is a great reason for that. Oil firm on the week. That's on a week of a commodity rout. It does manage to gain about 80 cents on the week. Here we are in the middle of the day on Friday. Coming up in the market, we have just so much to bring you. Arvi is going to bring you a preview of a member video on the international markets. And we have a huge demand from people from India on the Nifty 50. So we're going to show you that right over here. But generally, you're only going to see that in market week, maybe once every couple of months. And we're also going to bring you the Brazil IBOVSPA, IBOVSPA, for those of you that want to know what that is. And that's a really good one. Arvi does an amazing job, so you'll enjoy that. I'm going to bring you some deep analysis on the grain markets with a little analysis that brings you technical analysis lessons, and we'll be looking at corn, wheat, and soybeans. I'm going to bring you a short-term view in the stock market, where I'm going to show you the S&P 500. Very, very interesting repeating pattern we're going to look at in there that calls for more trouble. And I'm going to compare the XLF, the financials, which are giving a big warning to the market right here. So I think you're going to find that extremely interesting moving forward. So I want to make sure that you go to the askSlim.com website and do explore it, subscribe to our membership, and do go to YouTube if you're not watching this on YouTube right now, and subscribe to our channel. Click the notification bell. Make sure you like this video. Give us a thumbs up, because that helps us on Google. And Twitter, if you do go on Twitter, follow me at askSlim.com. You have questions on our membership info and questions on our huge offerings of education and analysis, write Matt at askSlim.com. Matt is our COO and really knows the stuff, and he will be able to help you with our giant offerings that we have here. Speaking of giant offerings, this is the final week for the askSlim Premium Service Preview. We only do this once a year, where we open up our content to people to see at no cost whatsoever. You don't even need any kind of a credit card. We've been running this now for a week and a half. We're in the final week right now. You're going to get the SIR Daily Snapshot, which is an unbelievable review of the stock indexes, SIR Stock Index, and the SIR Daily Live chart stream. That grid is amazing, 15-minute charts, and I'm going to show you an example of that from Thursday of this week, yesterday, which you're going to see how phenomenal it is. S&P 500 live chart stream, you're going to see that with 4 different time frames on it and our proprietary indicators. Our Future Speak show, this will be the last week it'll be available to you at no cost, where I do analysis on 24 different futures contracts, weekly and daily charts. On just so many things that you're going to just learn so much. You're going to get our daily trade ideas. Man, RV is so good at this, and you're going to get some great analysis that includes a video on what we bring to you every single day. The Slimulator ranking system, which is the 84 best traded symbols of stocks, ETFs, and futures with our algos built into there. And you'll really get a picture for what the sum of the evidence is and the momentum conditions on 3 different time frames, our cycle conditions, just incredible stuff. Plus, you're going to get our charts on there in static version on a weekly and daily with our cycle analysis, and the Slimulator momentum tracker, which is for longer term position traders or for investors, a 3-month plus view of momentum. With a chart built in there with our signals, and I can't even tell you how much is in there. It is so fantastic. 1,000 plus symbols available in there, plus 20-something canned groups that we look at. Do not miss this opportunity. Only happens once a year. Take a look at the SIR daily live grid right over here. This is from Thursday, and you get a great idea. S&P 500, the Nasdaq, and the Russell on 15-minute charts. We give you the supports, we give you the resistances, the key numbers in there, and we give you the acceleration zones. That's the yellow. When you get into the acceleration zone, the odds are better than 80% you're going to move through it. So it helps you target and then potentially stop at the next support. You see that right there. It usually, when it gets through, it moves through. It went through 3 of them here looking at the Nasdaq. It went through 2 of them here on the downside looking at the Russell. And the amazing thing is it shows you which are strong and which are weak. Imagine doing a pair trade where it told you the Nasdaq was strong because this is the reversal scout right there. You buy the Nasdaq, you short the Russell, and man, look at that pair trade explode. Unbelievably great information here, and you can get this free for 1 week every single day by just signing up to be a free member on askSlim.com. Just go to askSlim.com, become a free member for the access for 1 more week on everything I just showed you, and you will just be astounded at all of the information that we put out and all of the education that you'll get from our fantastic analytical team. That's the final week for our premium services preview. Sign up now, free membership. All right, we're going to bring you right now a preview of a member video that we give to our level 2, 3, and 4 members. This is on the international markets, and we're going to highlight in here in this preview the Nifty 50 and the IBOSPA. You're going to see the fantastic work that RV does. RV, one of our lead analysts, and I think you're going to find it really interesting.
So this is the Nifty 50. What we have here is just a series of very positive cycles as we've been highlighting in recent international markets videos. You can see this really swamp cycle that formed here, where we used up this whole cycle basically rallying, had a very minor pullback, then moved to new swing highs, and that is really a classic behavior for a swamp cycle. Then we had basically one more swamp cycle right here, where we essentially rallied for most of this cycle, had a very mild little pullback that just formed a bull flag, and then turned back up nicely on the upside here. And what's going on is that we are still in this rising phase on the weekly time frame. If we look at our upside references, let's move this to the right a little bit. We have an intermediate 61.8 at 16.046 and an intermediate 78.6 at 16.711. We have had a very nice run here, so it wouldn't be a real shock to see a little bit of chop to set in here. If we look at the daily, we can get some further clarity here. You can see that we formed our short-term low here, and that low is almost unreadable, as we had just really one day down to form that short-term low, and then we got another rally in this new short-term rising phase. We are testing this 161.8 at 15,861, seeing some signs of failure here. So we would look for some chop to set in here, and for this to really work its way back down to likely retest that key daily low at 15,459. That's really what we're looking for. The next short-term low is due 772720. Now, if we go ahead and shift over to Latin America, let's look at the Bovespa. So this is one of the most interesting markets that we really are looking at here, and one of the most positive markets. You can see we had this really hard to read pullback here to mark the key weekly low. These cycles have been super consistent going back really many years here. If I just maximize this window, you can see we add in these black vertical lines to show how the key weekly lows have formed relative to the idealized timing, which means relative to the troughs of these cycle brackets that we have drawn in on this chart. And you can see going back many, many years, they have been quite consistent. And based on what we see here, we are in this short-term rising phase with very strong upside momentum here as well. On the upside, we have a 78.6 at 132.421 and a major 100 at 137.421. Those are really the upside targets here, as long as the key weekly low holds at 117.630. So a very positive pattern here in the Bovespa. If we shift over to the daily, you can see our cycles right here, and we have been in this short-term rising phase right here. You can see this beautiful rally on the upside, and look what's happening here is there's just a very mild little bull flag forming here. We have a short-term low due 623 to 75. So we would watch for this zone from 127.492 to 125.297 to hold on the downside, and then to get another push back up. So this is a very nice pattern with very strong weekly and daily momentum here as well in the Bovespa.
All right, I'm going to bring you some analysis on the grain markets right now. We're going to look at cycle analysis. Maybe the Fed has it right and this inflation was transient. Well, you can ask that question because the food prices collapsed this week when it became very clear that the Fed stimulus was going to end sometime, somewhere. They were going to actually come to their senses and stop pushing all this money in that is going into the banks and just getting stuck there. And that's why velocity is so low. But money is finding its way into these speculative areas, and the grains had massive moves, and now that changed. Then the question is, why do you sell a rebound? Why wouldn't they just go right back up? And is there an opportunity here for traders? So we're going to go to the charts right now, and I'm going to put up the charts for the weekly and daily charts on corn and wheat and soybeans. And I'm going to show you that momentum has turned down, and that happened 2 weeks ago in the grains. And there are breakdowns in the daily charts. And those are good reasons to sell bounces when they come, because we are not looking for lows in these markets until late July to early August. That would mean that sometime really in the next 6 weeks, maybe 7 or 8 weeks, well, there will be rebounds that are likely going to fail. And I'm going to show you that as we look at this. So let's move over right now. I happen to have QQQ up here, which is not what I want to show you. We're going to start on the corn market. And here is the weekly and daily analysis, cycle analysis. For those that are new, I'm going to give you a little bit of a sense for what this looks like. The charts that you're looking at have have notations on them that give you a sense for the rhythmic motion in the markets. Cycles are like the heartbeat in the market. And you can see in here on the bottom are cycle brackets. And the cycle brackets give you a sense for the average cycle period, which is measured from low to low. So here's a cycle low here, Here's a cycle low here, and one that's due out here. And you can see the market declining, and, well, it hasn't made a low yet, clearly, and this points out to about the third week in July over here for that bottom. So again, you have this rhythmic motion right in here. Here's our reversal scout right there showing you the upward momentum. It flattens out a little bit here during the correction. When you see the word swamped, what it means is that this upward strength, and this is the 13-week moving average, this is the 34, that directional component is so strong it will not allow significant corrections. Well, that was really until right in here, and things began to change. Now you can see right here where this flattened out, the reversal scout, and you got into that correction. You didn't even flatten out here at all. That's how strong it was. And here it turned down, and you had like 3 or 4 weeks of modest decline. Here you've turned down, and you have about 6 weeks or 7 weeks of decline, and that shows you the momentum turning downward is setting up for a bigger correction. And the rebound that you see here, which hit the support, note the supports that we put in the charts right here, those set up a failure here at the resistance and this negative momentum, and now looking like it will come down again. The corn market here, target, is close to $6. It could get down here as low as $5.75, looking at that. So we have negative momentum going on in here, and now let's look at the daily chart. And we have a chart that has turned down. Now here's the key level right in here in this chart, 602.75, right around there. And if it gets below there, it will have broken down and set up the next cycle over here for lower prices. And here's what's key. This cycle right in here made a higher high. This cycle over here failed to make a higher high and failed in resistance. It's now coming down to threaten this cycle low, and that says to you that the upward force is gone, and we're now in a period of a downward force, looking right in there. So that is a look at the cyclical patterns in corn on the daily, which is setting a top in there. A break under 602.75 would be pretty bad, and that is a reasonable target on the downside right over here. Even in this minor cycle that we're looking at, it could happen in the next couple of weeks, or it could just simply chop around a little bit here and happen a little bit later in late July. But this is a bad pattern that has clearly peaked. /ZW, we'll look at the wheat market right here. And you can see the negative momentum as it turned down right over there. If you look at these other charts, when the momentum turns down, you can see the cycle patterns just absolutely gorgeous. And this one due right over here about the third week of July. This rebound here, very unlikely to hold. It fails in momentum, negative momentum going right here, fails in resistance, and now likely to continue on the downside. When I look at the wheat market right here on the daily chart, you will see it actually has broken down already. See the cycle right in here and the cycle right in here. Now I want to illustrate to you on one more thing that we have on the daily charts. This is the slim ribbon. The slim ribbon is one of the best momentum indicators you'll ever see. We use this on our daily charts. And when you see this green arrow, it says the momentum has turned positive and you're likely to see upward movement. When you see the red arrow, you see momentum is negative and you're likely to see downward movement. What we have going on over here is that it turned negative right there, and this rally fails under negative momentum condition in the sell zone and then comes back down and breaks this low right here. Also note on the bottom, this is the slim ribbon PO. Now the slim ribbon is available to everybody. We make that free. The slim ribbon PO is proprietary, and this is the signal indicator for the slim ribbon. And you can see in here where it's giving you a positive right there. It gave you this positive signal here. You got the rally. It gave you a positive signal here, but then it aborted right at this point, and the positive condition was over. Then it turned red and gave you sell, sell, and it began to move down. And it's about to give you another sell indicator right in the resistance. This rebound should be sold. The probability of it holding up is very small. And overall, we'll be looking for a break under that 640 area and maybe even lower. You can see this target over here on the weekly chart takes you down to about 593. And that is a lot of risk that we see in the wheat market. The probabilities of a rally holding are extremely small, and the probability of getting paid on the short side in these bounces is very high. Last one we're going to look at is the soybean market, and you will see something very similar in here. This has just extraordinary messages when you look at this. First of all, we have colored phasing in here. We do this on some of our charts so that you could see the rising phase and the corrective phase. You see that the bottoming phase right here, green it moves up, green it moves up, reversal scout very strong. Here's where the momentum turns very negative 2 weeks ago, and now it's broken that key low and it gives you this red zone. You don't get a lot of red zones in these big strong upward moves, but this one you have. This points to a decline out to late July, early August. Let's take a look at the daily chart over here, and you could see the cyclical rhythms that are fantastic. These vertical lines are showing you where the actual lows were in the cycles. These are the cycle brackets, which show you the average. It also has some minor cycles in there. You can see the minor cycle showing up right here and here, and probably getting a little minor cycle low in here, or in the next dip it will be so, but then this points to a decline all the way out here, lining up with the weekly chart. And we have a little message right in here that you could see. The cycle low of this chart aligns in mid-July with the weekly chart. So if I highlight this for you to see, you will see the date that comes up, hopefully. Where's that date? There. No, that's not it. Let me just get it to come up here. So that ends on July 22nd, right over there. So that's the third week of July. This should be declining to that date. Right over here, this on the bigger dominant cycle, this points to the third to the fourth week in July, right there. That shows you that the probabilities of declines in the soybean market are very high, and the rebounds are likely to fail, and we'll see things moving down significantly again. That is a look at the grain market, and that grain market telling you that at least for now, they are in a very significant period of correction, and that the reasons to sell a rebound, well, I showed you them. And I think that short side trades are the right trades. We never make recommendations to you. I'm not doing that right now, but I'm showing you the analysis for your education so that you can apply the way that you trade that's the proper fit for your style, for your risk tolerance, for your engagement in the market, for so many things that just make up who you are as a trader. And you can decide for yourself what is the best fit. And please do apply your own analysis to the analysis that we bring you. We want you to own your own trades. And that's key to success in the markets. All right. We're going to look at the stock market now, the short-term view, and we're going to look at XLF and make a little comparison in there. The reason I want to do that is because, well, I spoke earlier in the show, and if you're only watching this clip right now on YouTube, you should go back and watch the whole show. The interest rate structure with a flattening yield curve happens when the Fed tightens, or when the Fed is getting ready to tighten, the market moves ahead of that. So when banks loan out money, when the yield curve flattens, their margins get squeezed because they pay more for the money that they loan out, and they get less for it because the longer term rates are not keeping up with the shorter term rates. Or in this case, in this last week, we saw a rare circumstance where the 30-year bonds fell 9 basis points in yield, while the 10-year notes gained 4 basis points in yield. And that is what happens in a time period when the Fed is getting ready to tighten, or is in a tightening phase. Eventually, they invert the yield curves. And we saw some inverted yield curves in the last couple of years that was just on market conditions, really not on the Fed doing very much. and the markets don't like when that happens. So we're a long way from the Fed inverting the yield curve out there, but the markets are acting like they're, smelling it coming, and the financials have a very good message for us right now that I think is important to look at. I want to look at the S&P 500 first. So I'm going to jump off of soybeans right here and put up a special chart that I have here in SPX. The reason it's a special chart is because let me just get this blown in right over here, because I'm highlighting, I don't have all of our normal information on here because I'm highlighting a repeating 15-day rhythm in the market right over here. So I'm just going to look right in here, and you can see this 15-day cycle very clearly. So the low made right over here was 15 days off of this low, and this dashed line illustrates the ideal or average that is a 15-day cycle. So you could see this was actually a 16-day cycle right in here, because the total from here to here was 31. So this was 16. This was 16 right in here. And this odd shape right over here that made a diamond. Diamonds are often consolidation patterns, and it broke out on the upside. Distance from here to here, 15. You can see, let me follow this, 15, 16, 16, 15. You could see right there. And now we're in day 11 right over here. So what that says is that this breakdown that you have right over here, and we've had strong momentum, and it is about to go neutral. It's about to turn blue. That momentum is getting lost in here, and we're about to break that support right there. You see how close we're getting, and just getting close is bad news. So what that says is that this should fall, if this is day 11, let's just say 3, 4, 5, 6 days, somewhere right in here. Still, that doesn't speak very well to the market being able to rebound right now. And then this yellow zone is the correction of the bigger cycle. And you can see right in here and right in here. And that's what we've been talking about, was the fact that the market would be pulling back in here. And I've been showing the intermediate weekly charts, but I wanted to show the daily because I want to compare it to the XLF so you can see. So what are we looking for the next, 1 to 3 weeks? Well, it's further decline. The supports that you can see right in here are around 41.50. We talked about 41.50 the last couple weeks. And down over here around 41.30. Those are reasonable targets to get in this into the midweek next week. So we'd be looking for it to decline into somewhere around Wednesday, Thursday of next week. Tuesday might be a little early, and so Wednesday, Thursday of next week. And then turning up, and then this is the proof of life period. If the market does what we expect, break below this low, give you a negative shaped cycle, then the odds are very high it will fail before making a new high in the next rally. That will, if we still have a bull market right now, or a bullish market, it would be able to rally and take that out. I think it's a very low probability. I think it's going to try to rally here end of next week into the following week after that. It will not make a higher high and then move down pretty significantly. So that this target right over here, that comes off of some intermediate supports. That's at about 40.60. This one right over here, 40.40. The bottom of that support zone under 4,000. Right over there. Those are all possibilities out over here for the stock market in this corrective period that we're looking for that goes out into August, late July, early August. So this, we believe, is the beginning of the stair-step downward move, and this proof of life will actually be proof of death, and that the market will prove its peak and then be moving down. Now, I want to show you a comparison in here that I think is very significant, and this is a very good lesson on this style of analysis. Let's look at XLF on the daily chart. So we're going to look right in here as this uptrend was established. And what I want to show you in here is are the cycle rhythms. So this is the cycle bracket that you can see right in here. I'm going to highlight that cycle bracket so you can see how many days are in each of these cycles. Come on. Let's supposed to highlight and show you. There you go. So this is a 31 bar cycle. So it's 31 days. A lot of people that are cycle analysts use the nominal numbers, the 5, 10, 20, 40, 80. We do not because we believe every symbol has its own cycle rhythm. And you can see the rhythm is very clear in here at averaging around 31 days. You can also see that this decline right over here is coming into this bottoming time frame, which means that you're probably going to get a bounce coming in XLF. But here's the key lesson. If you take these ideal cycles right over here, see them moving sideways, and if there were no forces pushing it up or down, it would just move sideways. You'd get it moving up, you'd get it moving down. You get it moving up halfway and get it moving down. But when you have an upward directional component, as illustrated in all of these positive signals. You see the slim ribbon PO? These are all positive signals for momentum right in here. Positive signals. The corrections only went neutral, a little bit of negative right there, and then positive, 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 neutral, and then a little bit of negative that you see right over here. Each of these cycles gave you higher highs, climbing up this upward channel. The directional component, and you can see in here the 89-day moving average, showing you how it pushes upward. These green arrows show you the upward configured cycles, all of them positive. Some of them so strong that they got swamped by this upward movement that you couldn't get any significant corrections. All the way back here, this is into November, into October of last year. So this is a long upward powerful move right there until it changed. So the directional component that we're looking at in here that pushed it up has gone from positive, that you can see there, to negative, that you can see right over here. The upward channel has changed. And how do I know that? Well, this cycle low right over here where that came, it broke down below that level. The only way that could happen would be if the upward force was leaving. And that means that we're now entering into a period of a downward force. And that would give you a rebound that comes somewhere off of here, and then a rally that fails in the resistance zone, which I'll put in there once I have the anchor point. Whoops, sorry. And then the likelihood of this turning down for the next decline right there. That's, by the way, how head and shoulders forms, by the patterns in the cyclical charts. And now this proves that something very significant has changed. It breaks through all of these supports that you can see there, breaks through that cycle low support right there, tells us the upward component has become negative and it's now a downward component, and the financials are about to become market leaders on the downside. That means that the proof of life period that we talked about, that's not what I want, that the proof of life period that I talked about in the SPX right over here is likely to fail, and that the market is likely to move down. So in comparison, you can see that this is about to give you a little bit of breakdown, just like the XLF, and that the next rally is likely to fail, just as the XLF is indicating. That is, I think, a great lesson about how the key leadership can affect the markets. And with XLF turning negative, the financial stocks, the bank stocks, that is telling you that there is trouble out there. And again, we are saying that we think that the first wave of this significant correction in the market will take us into late July or early August on an intermediate basis. So this is the short-term view, which again, we reiterate, down sometime likely into middle of next week, an attempted rally, and then likely down again. And we'll be putting in the resistance zone once we have the anchor point for this low right in there. That gives you a very good idea as to how we do our analysis and why the stock market is very likely in a significant corrective period, if not the end of the overall bull. That is it. I hope this has been absolutely amazing. We want to make sure that everything that we share with you is highly educational, and do everything that we can to make you very successful. Your success is clearly our success. I want you to be so careful out there because it is so crazy. And we're always wishing you great trading.